Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, I think as many of you know, I do pre-tape my programs, and it is February the 1st. We have closed out January as one of the best Januaries for a number of areas of the market. The S&P 500 was up by 6%, the NASDAQ up by 10.5%. That's the best January since 2001. So what do you do now? Do you continue to own the same stocks? Do you take some profits? Do you sell? Let me bring in our guest today. Kim Forrest is joining us. She is the founder and chief investment officer, I should say, of Bokeh Capital. Kim, great to be able to chat with you and get your perspective. You're a veteran in the industry, and that's important to have those perspectives, especially in a very difficult environment, which it is.
Yes. Yeah, we forget that many managers who have half of their career have never been in a bear market before and have never seen, things that happened in 1999 to 2001 or 2009. Yeah. So yeah, it's okay. We're going to get through this. I know that.
Well, okay. And having said that, as our viewers know, I've spent a lot of time and discussion on the U.S. Federal Reserve, and of course that dovetails into the Bank of Canada. It is so important. It has really affected the markets. The central bankers have been affecting the markets since the financial crisis in terms of the easy money and lower for longer interest rate environment, and now the opposite is true. So we did just get the U.S. Federal Reserve's decision as it relates to the point raised. Let's just briefly kind of talk about that and how you're thinking about the Fed's effect on the markets.
Sure. So part of the comfort that I have with the Fed is it's being driven by somebody who actually worked in markets and is not necessarily a heavy academic that has only been able to look backwards and say, oh, this is why this happened, right? The guy has actually run market activities. So he understands intrinsically what happens when he makes a decision and when he says things. He's been completely transparent. And I believe that he knows that he can't create a very deep recession, but he does want to cool the economy down. So he's walking a tightrope, and it's kind of the worst job in the world right now, but he has it. And he's okay with that. So these are the things I'm thinking.
Oh, so he raised the rate by 25 basis points, very much as expected, and that the target range is 4.5 to 4.7%. That sounds a little bit lower than what the market was anticipating, or although maybe not, because the market's rallied so much.
No, he's been very great at communicating this either directly or through back channels, that he is very, what he's going to do next. And by next, it's the next meeting, but maybe not the meeting after that. So here's the thing. We have markers of a cooling economy right now. And I guess the big question that the bond market and the stock markets have been thinking is that there's a pause coming. And I think that this next half an hour that we'll live through, we're going to see if he's amenable to a pause or not, or if he thinks he needs to go higher. And that's the big question.
Right. And that is the big unknown. And as I say, we pre-tape this and they come out with the decision, and then they have commentary, and it's always in the wording and the tone of what he says in terms of what the market then interprets. So we'll see what that brings us. But what do you think? How have you been positioning your portfolio for clients?
So I have a very long-term view. I have a 3 to 5 year timeline for anything that gets added to a portfolio. So that is, anything can happen in the next 3 to 5 years. So what we're trying to do is pick good companies with great products and good enough management and good balance sheets. And this all sounds good, but these are the kind of companies that get you through tough times, and more importantly, have the markers for growth once times get good. And that's the way I've always run portfolios. So we haven't really changed much at all.
Okay. And we're going to get into the stocks and your approach and some of those specifics, but I want to get your take as well. What's your view of the U.S. economy right now?
I would say that it is slowing, but it's still patchy. There's a lot of jobs that are unfilled, and it's unclear that we even have the people for them with the skills. So there's a
Okay.
lot going on.
All right, we're going to take a quick break and we'll pick that conversation up on the other side. We'll be right back. Kim, I want to get a little bit more detail in terms of what you're seeing in the U.S. economy, but I also want to give you some communication from the U.S. Federal Reserve and how you would interpret this. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. What does that mean?
Whew, that is a hard
Right?
one. Okay.
Well, that's a
So,
hard one.
yeah. So at first you're going, uh-oh, they're laying down the hammer. And yet they're telling you two things at the end there. They're saying, well, we want to get back to 2%, but maybe we're going to stop the hikes before we get to 2%. I think that's what I heard when you said that. And remember, I'm an equity analyst at heart. So I see that glass half full. So, take everything I say with a grain of salt. But yeah, I think that they are preparing, probably saying that they're going to raise maybe once or twice more, and that'll be that. I'm thinking.
Okay. Yeah. I'm an equity person as well. And so we are half full, and people should understand that fixed income people tend to be the glass is half empty. So that's just kind of our bias. And it's an honest bias. It just is what it is. But but let me get your take as well as it relates to the U.S. economy. And we see housing slowing down. We know that inflation has impacted people. We see a strong labor market, but that's also can be very, very backward looking, particularly as we hear daily large corporations on their conference calls or or after the fact are laying off people in the thousands.
Right. Well, there's a couple of caveats there. Let's start with, first of all, I don't think we got to address this in the last segment. In the beginning of 2022, when gas prices were really high, probably from the 60th percentile on down, they were absolutely in a recession. The people in that group of earners, because so much of their money was going into just real basics. As the summer wore on and we got relief in gas prices, it just didn't feel like there was a recession. But I think we've had this, even though it may not show up in GDP, we've had a low-level recession going on in many areas of the US and in many different industries. Now, the weird thing about all these layoffs that we're hearing is it's in the top 10% of earners, right? These are the big companies. Well, at least that's what it was initially, the tech companies. And the funny part here is they're in companies where people are very richly rewarded, but they are the people that are either the product or making the product. Now, when they go to their next job, which may not be at the same sort of company, maybe they go to where they're in an IT department somewhere, they're going to still earn a lot of money, but it's going to be less. So some of what we're seeing in the jobs numbers is that falling pricing for higher end individuals. And that could be really helpful to the Fed in their pursuit of lowering the temperature of our economy without making us drive into the ditch, if I can use a mixed metaphor there.
Right. No, that makes sense. It's quite astonishing to see all these companies lay off people, and many of the CEOs or interpreters analysis of the moves will say that that's because they overhired.
Maybe.
I don't know. Yeah, I know.
I think a lot of the tech companies.
It doesn't make sense. It doesn't make sense to me.
Well, I think what they're doing is paring back projects that they were going to take a flyer on. And many of the people, I'm not saying that everybody in that project that they were assigned to gets eliminated, but they'll do right sizing with respect to the skills they think they need in the next 5 years. And that's what's happening.
Yeah. Kim, we're going to talk about your portfolio in a second, but I want to just ask you, do you see any cracks in the system right now?
Cracks in the system.
Yeah.
There There are a lot. I think we are not educating the people that we need for the next 20 years. We need more
Okay.
engineers. We need more people that are comfortable in, mathematical sort of endeavors. And that really feels lacking. And I don't
Hmm.
know where we're going to find people. It's a huge problem. Huge.
Oh, that's fascinating. We don't often think of. I mean, we do, of course, think about that from an education perspective. But when I asked the cracks, I was actually thinking more from a financial perspective as it relates to I don't know whether it's the credit market or what have you. But you are a longer term investor, so that makes a lot of sense that that's how you're looking at it. We're going to take a quick break, and we'll be right back. Kim, I want to talk a little bit now about your strategy, how you approach investing, and for clients, for viewers, to understand that you manage a portfolio for direct clients, but also for other investment advisors who can access your fund. Correct?
Sure. Yes. Yes.
And what's the
What
approach?
we're
What's your
doing,
strategy?
yeah, uh, um, it's all about risk remediation. I was trying to encapsulate it. So what we're doing is we're running a concentrated portfolio of US traded stocks that are $1 billion or more in market cap. So we don't have teeny tiny companies, but we do have some smaller um, firms in there. And what we're trying
Okay.
to do is keep up with the market. And we do that by maintaining a sector weighting that approximates the S&P 500. So for example, we have about a 4% weighting in energy, a 25% weighting in technology, and concentrated means our original buy of a position is probably around 3%. So we have 33 names right now in the portfolio with a couple of smaller positions. And it's been working
So
well since 2020.
yeah, and these will be your 3-year numbers coming out, and that's a big
Yep.
marker in the investment world. But you can't tell us what they are yet, right?
No, I can't. Sorry.
Okay,
And
that's SEC
we're
rules.
right on
But
the
we'll have you
cusp
on.
there.
Okay, perfect.
Okay.
But we'll get that to our viewers when they come out. But why is it that you like sector neutral? You're mimicking the sector weighting of the S&P 500, and then I guess where your alpha or where your expertise comes in is actually choosing the best stocks within those sectors. Why do you think that that's a good approach?
Right. Well, for a couple of reasons. First of all, the person who I first I created this for, they wanted a little bit of growth, but not a tremendous amount of risk. And what I've always seen, especially watching financial shows, is that at the beginning of the year, we all give our guess about this is the year for energy or financials, it's going to be the year or whatever. And people overweight and underweight these sectors. It's a way to do it. But if you're also a stock picker, it's really hard to pick, really good companies and then overweight the sector. And I have not seen a whole lot of people that can do both and both well and both over and over and over. And at my prior firm, one year we did not have any energy and it was the year for energy. Lesson learned, right?
Mm.
So,
Mm-hmm.
so it's good to be older. You get to see the past and go, I'm not going to make that mistake. I'll make a different mistake, but not that one. So that's
Right.
how we came up with this. And it's been tracking really well.
Interesting. And why that's also so important as well, to your point about, a lot of people don't get both calls right. So you'll have hedge
Right.
funds and macro hedge funds that just make the macro call, and that's what they're
Yeah.
doing. And they're not really picking the stocks. Or you have stock pickers. So it's really important for people to understand you're not good at everything. Even when I worked on Wall Street, we could have an analyst that had the great kind of big picture call, couldn't pick a stock. You almost did,
Yes.
we just did the opposite. So, and that's true. We were like, okay, we're just going to do the
It's
opposite. If he
terrible.
puts a buy, we're selling. So it's true. So
Yeah.
that's the way it works. Yeah. So we don't have to talk
the
about the
other thing,
sector weightings. Yeah, go ahead.
the other thing that we do, and this kind of has been the secret to our success, is, as I said, we have $1 billion and up market cap. What that's doing is that's allowing us to have some mid-cap names. And because we're going for really high quality companies that make products that are going to really satisfy their customers, and by the way, they probably have a good process for doing that, they are often the object of takeovers from the larger firms that are also in the mix. So that's where a lot of the alpha comes from.
Understood. Let's talk about a couple of names that you own. I'm curious. Coca-Cola.
Yep. Well,
Why Coke?
my first career was a software engineer, so I look through the lens of how well a company deploys technology. Makes sense? And oddly enough, Coca-Cola is really a good user of technology, and that makes it a very profitable company. I also like how they have gone off of their long-time fizzy drinks only kind of menu, and they now have coffee, and they're expanding into alcohol. So they have a good handle on what they need to do, delight the customer, and they're trying a lot of different things to do that.
And is valuation still attractive here?
It is, and that's because we're looking 3 to 5 years in the future.
Okay, we're going to take a quick break. We'll be right back and get some more top picks. Kim, so you were just saying Coca-Cola is attractive because you take a longer term outlook, but I'm just curious, what is it trading at about? Sounds like it's got a 2 handle on it. I haven't looked at it in a while.
You mean the PE?
Yeah.
Okay. You've got me on a bad day.
That's okay.
I don't know. But
okay, that's okay. It's still attractive on a longer term basis. Let's take a look at another one as well. And you also are excellent in the tech sector, which we'll get to in a moment. But I think it's always interesting to hear about more of these consumer staples names or names that people really understand, like a Coca-Cola, and also a UPS. What's your view of UPS? That's one of your stocks as well.
So UPS is a technology company that just happens to deliver packages. I mean, I have actually gone to see the company numerous times. They have invested unbelievable amounts of money into making themselves extremely sleek and able to know where those packages are, how long it's going to take to deliver, and then who is a profitable customer. I have to tell you this. I love the new CFO or CEO who was the CFO of Home Depot when they went through their big expansion. And last year, she fired a whole bunch of even their larger customers that were not terribly profitable for the company. I think that's the right thing to do, especially, with her job is to return shareholder value, because sometimes more isn't more. She wants shareholders to be able to know that they're going to get their dividend. It's going to increase, with the growth of the company, and she will grow the profits of the company. And that's a bold move to make, to fire some customers.
Yeah. You do want to fire customers sometimes. We did actually do that on Wall Street at one of the firms I worked for. If it makes sense. But interesting. I didn't know that she was a CFO of Home Depot, but that's an interesting move for UPS. Let's also talk about within the energy space, the stock that you like there.
Sure. Our sole position filler for energy is ExxonMobil. And we like this company because again, it deploys technology well, although this time it's in project management. If there's one way to look at that company, it's not necessarily about what fields they own and where their plants are. It's how do they get the product to the place where it needs to be. And that is all project management. And it's something they're exceptional at. The other thing is they have diversified revenue streams. They're not just making gasoline. They make a whole bunch of other chemicals that, of course, have petroleum at its base. So we like their diversified geographic footprint, but as well as their product diversification. It's all about risk remediation for us here.
Right. And full disclosure, I own Exxon and have for a couple of years now. One other name that I'm not familiar with, RPM. What company is that?
Sure. This is one of our smaller names, and it is the company that makes Rust-Oleum and a whole lot of kind of chemicals that you'd find at a Home Depot. I believe they make DAP as well, all of those caulks and sealants. And about 60% of their products are commercial. They are the stuff that if you're a building manager or building a new food processing plant, you would have them put your floor in so that it meets the standards of whoever your regulator is for, food cleanliness, that kind of stuff. So they have a
Whoa.
very diversified um, model of chemicals, and they're a Midwestern U.S. company and have that sensibility that they know they're owned by their shareholders.
Hmm. What was it that led you to this name?
Um, to be honest, just a scan, a screen that they looked good on
Yep.
at kind of a sort of a value play a couple of years ago. But then I got to
Hmm.
know the company and saw how much they really do. Um, they're good at what they do. They acquire these smaller brands, build them up
Mhm.
into larger brands, and then return shareholder value, which that's what
Hmm.
I'm always looking for.
Interesting. I'll take a quick look. We only have about 20 seconds left, but I want to ask, with the rally we've seen in the semiconductor space, do you continue to own it?
Absolutely. They're the things that
Okay.
deliver the technology to us. So, of course, I love
Okay.
semis.
Okay. We'll leave it there, Kim. Great to see you. And thank you, everybody, for watching. We'll see you next time.